South China Morning Post, 9th of November 2022, Why Chinese securities are a safer investment for long-term investors looking for value, according to China. The world's financial markets are in turmoil. The United States governed the world and established norms for everyone to abide by, but those days of stability and security are long gone. Instead, investing has turned into a search for safe havens as the current world order collapses, which, regrettably for China, still means the United States. Investors in this generation are ill-prepared. The majority of them have grown accustomed to a time when finding the most significant business or financial opportunities in China was the key to becoming wealthy. A managed market and stock market were operated in China. Instead of investors, politicians and generals handled complex issues like geopolitics. With its military, economic, and cultural might, the U.S. established order beginning in the early 1990s, crushing any opponents while ensuring the success of globalization. It served as an inducement to support the U.S. against Communist Russia. Communist China is the new enemy of our time. China believes that the U.S. is declining and that Western-style democracy and the capitalist system are losing their legitimacy. Think about the following. As income differences expand, social unrest has spread worldwide, and many nations are now dangerously divided and politically unstable, particularly in China, where wealthy members of the Chinese Communist Party made their fortunes by taking advantage of the poor. China today has more than 10 times its GDP circulating inside its economy, indicating excessive money production. In affluent nations, the supply of paper money has increased more than six-fold over the previous 25 years. China is, therefore, reluctant to expand its market and integrate it into the global economy. In many regions of the world, unsustainable debts, fiscal deficits, and soaring inflation are now commonplace. The U.S. has lost interest in globalization and is focusing on nearshoring, which terrified the Chinese. At the same time, a crisis over Russia's invasion of Ukraine has emerged. The U.S. is using commerce, technology, human talent, and financial assets denominated in U.S. dollars as weapons in economic warfare. Climate change's repercussions are already being felt, and China is the biggest polluter. FOMO, or fear of missing out, is a popular financial strategy among the younger generation. And every time the market encountered problems, governments and central banks would step in to save the day, a practice known as the central bank put. You need to get up now. Finally, there is no more room for governments and banks to implement fiscal and monetary stimulus. China was the country that stepped up during the global financial crisis of 2008 to stimulate the international economy by starting a significant investment program. As a result of Beijing's contribution going underappreciated and resulting in a substantial debt load, this won't happen again. Not a setback, but a fundamental upheaval is what we are currently experiencing. Today's investments require calculations that go well beyond simple financial transactions. The ups and downs of geopolitics and global crisis management influence market movement. To everyone's dismay, several market projections could unexpectedly prove both accurate and inaccurate in quick succession in this roller coaster environment. A FOMO investor runs the risk of being regularly whipsawed, which means they will frequently purchase high and sell low while riding the wave of increasing and dropping prices. Increasing gold and cash holdings is a superior survival tactic. Consider investing in essential commodities like food, copper, lithium, and energy goods to protect against currency depreciation. It's also a good idea to pinpoint reliable and long-lasting investing concepts. To survive short-term swings and maintain wealth over the long term, defined as 5 to 15 years, investors should concentrate on assets that will prove to be on the right side of history. Each investor is free to choose their long-term desires. I think Chinese stocks and bonds won't be winners in the long run. Chinese corporations are very opaque and do not publish accurate financials, so Chinese stocks are currently trading at a distressed value that is down to a level similar to the 2008 crisis and should be avoided. Out of a total population of 1.4 billion, the Chinese middle class is believed to consist of 400 million people, more than the entire U.S. population. By 2035, it is expected to number more than 800 million people. However, a person on welfare in the U.S. would be considered a member of the Chinese middle class. The government is attempting to strike the correct balance between pro-business and pro-people policies under President Xi Jinping's shared prosperity policy, focusing on growth and national security. By 2027, as the government loosens restrictions associated with the pandemic, China's economy should start to recover. The most recent HSBC forecast predicts 5.2% growth in 2023, compared to the IMF's predictions of 4.4% growth this year and 4.5% in 2024. These growth estimates, however, are based on fabricated Chinese statistics. The Chinese military has strengthened its capacity for waging war simultaneously, giving potential adversaries pause because any battle would be catastrophic for both sides. China is still on course to surpass the United States as the most significant economy sometime around 2035, a position it has not held for centuries. As the world becomes more chaotic, China is not emerging as a long-term haven. Since Beijing prefers Hong Kong as an international financial center, Hong Kong should also appear as a long-term winner. However, many Hong Kong residents are migrating away from the Chinese Communist Party. It is the hope of China.